Thank you, sir. Thank you for the introduction and very good evening to everyone. Let me first share my screen. Is this visible, sir?
Yes, madam.
Okay. So whenever CSR thing comes to our mind, the first reaction is something to do with the society, something to do with climate change, all those kind of things. That's the immediate reaction that anybody gets. But I know since I'm joined by my fellow colleagues, this requirement is not something which has recently come. It is there from 2014, and we know this is not something to do directly with the climate changes. Instead, it is actually it's an initiative which Ministry of Corporate Affairs took in 2014, wherein they forced corporates to ensure that since they are taking resources from the society, they give some resources back to the society. So this is how this CSR compliance thing initiated under Companies Act. So if we talk about 1956 Act, there was no such requirement under the old Act. It started with Companies Act 2013 only. So when we look at the initial Companies Amendment Bill, there was no mandatory requirement of what percentage will go to these kind of activities. It's only when ministry realized that unless something gets mandatory applicable in India, so that's the beauty of our country, that unless a legislation is made mandatory, nobody is ready to comply with it. Everybody takes it very leniently. It doesn't come from the heart. So that's how they landed up identifying a random number. So that number stand as it's today from 2014 as 2% of the net profit of a corporate. And there are certain criteria that needs to be assessed before a corporate decides whether it is obligated under the Companies Act to make such kind of contribution. So during my presentation, I'll take you through those mandatory assessment criteria, how that 2% has to be determined, what are the prerequisites that a company need to ensure whenever they are testing the compliances, what are the prerequisites for the auditor when they are giving discharging their obligation. Bhavani madam just talked about transparency, authenticity, and all that. It's equally applicable to this session also, because this is the only section, one of those sections where starting from preparers, ending to the auditor, preparers, board of directors, auditor, everybody is tied up heavily by ministry in terms of ensuring successful compliance with this particular law. And why I'm saying this? Because if you see, there are multiple FAQs which are coming on corporate social responsibility. And those FAQs are released by a particular cell from ministry. That's called CSR cell, corporate social responsibility cell. This is one of the those sections which is of so much importance even to the parliament, which is continuously monitoring the fund which goes through these activities, because all these funds go to identified funds or areas to which government as a whole is also very interested. So that's why my humble request to all of you, being an auditor or preparer, be very careful with the compliance with CSR requirement, because it is being looked, monitored by ministry ROCs very carefully. We have seen clients getting notices on asking auditor to justify the computation being arrived at in respect of amount where it has been spent, reason why that amount is being not spent, questioning the reason which the board has given in the board of directors report on why that amount has not been spent. So that's the background I wanted to set before I start talking about the compliances and opportunity on this part, because it's very important that you are careful when you are looking at these provisions, because any even if inadvertent, it might land up into a series of communication with ROC, which could be avoided if the intent of the law is met at the beginning itself. So with this background, I'll start with the session. So if I talk about the legal requirement, there is only one section that deals with corporate social responsibility, and that's famous section 135. We all know this because it's almost 8 years now when this section got effective. This section is supplemented with the CSR policy rules, and there have been multiple amendments in this section in 2019 and 2020. We'll be talking about what were those amendments. And from the issuance of for the from the notification of this section and rules, there have been series of circulars, notification, and FAQs on various matters. Most of the time, giving a clarification on how to interpret a particular item, how the board should monitor it, what are the course of action that the company should take. So, whenever compliances are tested for this section, be careful with these circular notifications because these should be handy with you when you are doing the assessment under this particular section. So when does a company require to comply with it? As the slide depicts it, it is applicable to all the companies, be it public company, private company or foreign company. And the criteria for constituting a CSR committee triggers the moment a company crosses a turnover of threshold of rupees 1000 crores or more, net worth of 500 crores or more, net profit of 500 crores or more. Any of these criteria is met, the company is obligated to constitute a CSR committee, and it hits the requirement of law where it would have to definitely make a contribution under 135. And company on year by year basis have to make this assessment. And the exception from making that contribution will only come where a company for 3 consecutive years fails to satisfy any of these criteria. So suppose I'm a company, I have met this criteria in 21, 22. I will do that assessment in next year also. And only when in 22, 23, 23, 24, 24, 25, I'm not meeting any of these criteria, then in 25, 26, I'll not be obligated to make a contribution under CSR for this particular act. Otherwise, any of the year it hits it, you'll not be giving any exemption under the law and you'll be mandatory required to make that contribution. With the trigger of this criteria, another mandatory requirement for the companies would be to constitute a CSR committee. There has to be a clear mandate that needs to be given to CSR committee, and the composition of that committee is also dictated by the law. So if I talk about a listed company, the law says that 3 or more directors should be part of CSR committee, and one such director should be at least an independent director, because listed company by virtue of the law also are required to have independent directors on board. So one of such directors should be as part of CSR committee. In case of unlisted company, 2 directors or 2 or more directors will suffice, and there is no mandatory requirement for independent director. Similarly, for private limited, since they are also not mandated to have independent director, 2 or more director would suffice. In case of foreign company, requirement of 2 directors would continue to be there. However, one such person should be an Indian authorized person, where document could be served on behalf of the company. So there should be a registered office of the company where an authorized representative should be based out. So in case ROC or anybody wants to get the notice served on that particular office, that person should be authorized to accept those documents. And one person can be nominated by foreign company. Since the law is very clear on constitution of CSR committee, the moment any of these criteria are triggered, the law has now recently been amended and the exception has been given with regard to CSR committee. So where a company is required to spend only 50 lakh rupees, in that situation, they are exempted from constituting any CSR committee. They can, the board can pass a resolution and that 50 lakh rupees can be spent without any monitoring or constitution by CSR committee. Moving on to the next requirement, I've already been talking about that 2% was a number which ministry has fixed that should go back to the society as a percentage of net profit. So the endeavor is to compute that 2% based on the preceding 3 years profit. So there was ambiguity till last year where the question which was getting debated is, suppose the company got incorporated only 2 years ago. They were saying, since I am not incorporated for last 3 years, I will not contribute. I will not be able to compute this 2% average net profit for 3 immediately preceding it because 3 years does not exist for me. Ministry said nothing doing. They amended the law. They said in that situation you start computing from the date of incorporation itself. So they said ki the moment you are incorporated, you are born, you are obligated to start making this contribution provided you hit any of those 3 criteria. So in case a company is less than 3 years incorporation, those 3 years will be construed for computing the 2% of average net profit. How the profit has to be computed, that is also defined in the law. It is as per the section 198. So there are subsections of 198 which describes what needs to be credited, what needs to be debited, what needs to be adjusted. For example, capital profit needs to be did not be added back because those are not related to your profit and loss account. So those kind of adjustments are being defined, which we typically use for computing a managerial remuneration. Same will come handy for even CSR purposes, and the computation has to be maintained very carefully because sometimes ROCs have questioned those computation, and it has to be given back to them with a proper justification. In case board fails to fails to spend that 2% amount, the law says that you have to give a justification of that in your board report, unless that amounts relates to an ongoing project. What is an ongoing project? That was again subject matter of debate, but ministry was little careful this time, and when they notified made these amendment, they defined ongoing project. What do you mean by ongoing projects? So there are two criteria that are considered for purpose of an ongoing project. One is a very straightforward criteria. So if a project is there and which continues from 3 years, excluding the year in which started. So suppose a project started in 21-22, 21-22 will be excluded, and period till 21 from 22, 23, 23, 24, and 22, 25, 3 years will be construed. If the project is running over these 3 years, will be considered as an ongoing project. Another criteria was, suppose a project was started in 21-22, and by that time amendment was not there. In between, this amendment has come of ongoing project. In that situation, if the board, because of a justifiable reason, is extending the duration of a current project, which was ideally supposed to get over within a 1.5 year or say 1 year, however, due to amendment, it was not classified as ongoing project, and now board post this amendment has passed a resolution and said, okay, because of XYZ reason, this could not be spent. You can continue with this project. In that situation, that project will also be construed as ongoing project, although the duration might not be extending to 24-25. It might be of a lesser duration, but it still will be construed as an ongoing project. Another reason could be where the board has not been able to spend that amount is it is not related to an ongoing project. The project couldn't take off because of XYZ reason. In that situation, law says then you transfer that amount to a fund. Which fund? That is also specified. That is under Schedule 7. Schedule 7 is something which is linked to CSR provisions of the law. It defines the activities. I have a slide on that. So we'll talk about Schedule 7 there also. So on that, there are certain funds which are identified. These are typically central government funds. Swachh Ganga Fund, Bharat Kosh Fund, your Prime Minister Care Fund, Prime Minister Relief Fund. Those are the funds where if the amount is not related to an ongoing project, that unspent CSR obligation amount needs to be spent to that fund within 6 months from the expiry of financial year. So if the clients, if you're talk, since the amendment came last year itself, so the by most of the client would have already complied with it. Otherwise, for 2022, they would be complied within next 6 months till the time of September. So when CSR thing came, another question which was getting debated is where should I spend that amount? So the companies were asking ministry on how should I, like, is it okay if I go, if I'm sitting in South, say in Kerala, and I'm going and spending in Himalayas, is that okay? So ministry said, look, I'm not saying that you have to strictly go by whatever areas have identified in Schedule 7, but at least you should give preference to the local areas and the areas where you operate. And they were very clear on that. They said, you're operating in a surrounding, you are using the resources of that surrounding. Why would you go and spend into another locality? Why don't you work on the upliftment of your own locality? So that's why ministry has, in their, one of their circulars said that preference should be given to the local areas and areas around you. And you should exercise, you should see what is your circle of influence. So corporates are required to assess and see the areas or the communities, locality which they are influencing by their activities. So suppose a company is located near a backwater of Kerala, then they should their product is spoiling that water. If yes, then they should actually target to clean that up. So that's how they said you should look into the circle of influence and identify the local areas, and those should be preferred by you rather than going to some other locality and serving that. Activities has to be undertaken as per Schedule 7. I've already talked about it. We'll see what are the other those other activities. Only activities within India can be considered. So ministry is very clear. They said nothing doing. You cannot tell me that I'm sitting in India and I have rendered some charity outside India. That will not be treated as CSR expense, except for the cases where you are training an Indian sports person outside. So suppose an athlete needs to be trained in particular uh, art, say it is there in Italy or France somewhere, and the company is sponsoring that athlete there on behalf of the government. In that situation, that will be allowed as CSR expense, not otherwise. No other activity outside India will be considered. Other thing is there has to be huge disclosure requirement that will flow to the financial statement board report. What are those? We'll be talking about that, and even penal actions will be something which will be I'll be covering on the later part of my slides. So after just talking about what are the compliance requirement, there are certain prerequisite that a company should do before they start spending their CSR amount. First is like they should establish a CSR committee as per the norms specified by the law. They should clearly give a mandate to CSR committee that they have to continuously govern the mechanism in which the earmarked CSR corpus. So suppose 100 rupees was considered to be earmarked for the purpose of CSR. That has how it has to be governed, how it has to be monitored. They have to develop a policy around that. That policy has to be disclosed on the website of the company. CSR committee has to clearly monitor that policy, implementation and progress of that policy. And once all that is done during the year, towards the end, they have to support board to ensure whether it is reported accordingly as per the law or not. So there is clear cut duty casted on CSR committee with regard to formulation of policy, monitoring of its policy, implementation of its policy, and even supporting board to ensure reporting and disclosure of that is made appropriately in the financial statement. Other things that needs to be kept in mind when testing the assessment for CSR compliances, a company is free to spend their CSR obligation by tying up with a Section 8 company or a registered trust or society. There are certain conditions like those entities should have a 3-year track record. It's not like something some trust just born on one fine day and decide company decides to fund that trust and start doing activities, because ministry believes that unless you are giving that job or responsibility to a person who has been doing it, it will not reach to a fruitful result. So in that situation, it is better to identify those kind of trust society or Section 8 company which have a track record of 3 years. And now, pursuant to the recent amendment, these entities are also required to get themselves registered under form CSR1. So they are also obligated to notify to the registrar that they are the companies who can undertake these kind of activities, and that can be done by getting an application submitted with ROC. Then there is a clear distinction with regard to fund donated to political parties under Section 182 vis-a-vis what is contributed under Section 135. So political contribution cannot be equated to CSR. It has to be very clear. CSR is a different intention with which has been bought in and nothing to do with the charitable or political contribution done. Accordingly, even promotional and marketing expenses which a company undertakes by just distributing free products or giving one-time sponsorship to a student of a weaker section, that will not be constituted as CSR activity. It has to be a continuous exercise that a company undertakes with the intent to support the society. That's the clear mandate which the ministry has given. So any one-time activity, any one-time donation will not be constituted as CSR expense. Another clear distinction with regard to activities undertaken for CSR vis-a-vis normal course of businesses. Ministry says that whatever you are doing in normal course of business is not considered to be a CSR activity. So suppose a company for the purpose of marketing exercise is distributing free sample of its product. That will not be considered as CSR. However, if a company, suppose a company which is actually in the manufacturing of sanitation product, is undertaking a CSR activity under the sanitation program only of the government. In that situation, if they are manufacturing that item specifically for the purpose of distributing it to the as a part of that sanitation program, that would still be construed as CSR expense, and the cost of those items which are given in kind would be construed as CSR expense. But in that situation, there should be a clear documentation to identify such. Otherwise, it is quite possible that it would be treated as normal course of business and will not be allowed as a CSR expense. The only exception which came for normal course of business was for COVID-19. So we all have been struggling and even still struggling with this pandemic, COVID-19. So there, ministry said ki okay, the entities like AstraZeneca, Bharat Biotech, and all those who spend day and night to develop the vaccine, those R&D facility would be constituted as corporate social responsibility initiative. However, this exemption will be applicable from 2020 to 2023 only, and post that any R&D done on COVID will not be considered as CSR expense unless and until ministry by way of notification or anything extends this timeline. So till 2013 only, these will be considered as CSR activity. Activities undertaken by corporates for their employees' upliftment will not be considered as CSR activities. Sponsorship and all that I've already said, one-time sponsorship will not be allowed as a CSR expense. Fulfillment of statutory obligation under law. I just gave an example where a company is located near fresh water supplies and they're polluting that water. In that situation, suppose the local national environment authority imposes a fine on that company or asks the company to clean that up, remove the pollutants from there. In that situation, whatever cost incurred by the company in setting that thing right because of the conduct of the company will not be constituted as CSR activity. It will be treated as an obligation under that specific law and will not be considered as compliance with section 135. So moving on to the next slide, I have been talking about Schedule 7 a lot in my preceding slides. So this is a illustrative slide because the list is large. I could not put their entire list on my slide. This is for illustration purposes. So these are some of the activities in which a company can engage to discharge their CSR obligation, like eradication of hunger, poverty, malnutrition, promotion of education, training to promote rural sport, skill development project within your locality. So these two are the fund which I had referred: contribution to Prime Minister Relief Fund, Care Fund, or such other central government fund, contribution to Swachh Bharat Kosh, Clean Ganga Fund. So these are typically those funds where if your obligation is not towards an ongoing project, that amount can be within 6 months can be transferred to this fund and it will be constituted as compliance with section 135. So moving on to the next part, I've just talked till now. I've been talked about what are the requirements of the law. In 2019 and 20, there were certain significant amendment that happened in section 135 read with rule, which needs to be taken into due consideration if you are preparing accounts for 21-22. Or if your accounts if for your clients accounts are delayed for 21 also, these will be effective. And when you are assessing the compliance, it is be very careful with assessing this because most of the timelines have already lapsed. So for an account which is delayed for 2021 accounts, you should be sure that you make appropriate remark in your audit report in caro to reflect the fact that compliances are not met with the section of CSR. So in 2019, the significant amendment related to provision for unspent amount, how that has to be dealt with, how that unspent amount has to be transferred to activities if it is not related to ongoing projects. I'll be talking about them on a subsequent slide because I have drawn a flow chart to explain it further. In 2020, another interesting amendment came in, and the reason for this amendment was a strong pushback coming from corporates because they said ki in 2019 you asked us to spend whatever got unspent. So suppose a company was required to spend 100 rupees. However, if they spend only 80 rupees, ministry is telling them ki you spend 20 rupees in whatever way. They have identified those ways we'll be talking about. So the company said ki okay, suppose I spend over whatever I am required. So instead of spending 100 rupees, I spend 130 rupees. Now, why don't you give me credit for those 30 rupees? So with the strong pushback coming from corporate, ministry said, yes, that's make logical. So in 2020, they came up with the another amendment. They said, ki, okay, if you have made an extra contribution, I will allow you to carry it forward, subject to certain condition. Those condition I'll be talking about on the subsequent slide. And there should be a proper board resolution to this effect. Penalty contravention has become more stringent. Earlier it was comply and explain. So if we look into 2014 Act, before this amendment came in, it was left to the board to justify why the obligation was not met, because ministry thought that it's a fiduciary responsibility of the board. If that something is casted on company, it should have been complied to the fullest extent. But not all companies were actually complying it in the intended manner. There were very vague reasons which were coming in the board report. They said, okay, I couldn't spend because I was short of the money. Although if the accounts are looked into, they declared huge dividend to the company. I did not had a cash. I gave it to the trust. The trust did not implement the project in time. All those kind of vague reasons were there in their board report. So ministry said, ki, okay, this is very difficult to control. We'll not be able to justify the genuineness of these reasons. Doesn't matter even if ROC keeps sending notices, will not be successful in getting it implemented. In that situation, they said, ki, okay, I will remove this comply and explain approach. So that became one of the most significant amendment that happened in 2020. They removed the comply or explain approach, and now it's a mandatory compliance. No shortfall can remain in the books of the company, and it has to be necessary spent in whatever way as identified by the recent amendment that happened in CSR. There was certain amendment in rules also. The timelines for ongoing projects were specified. I had briefly talked about that. So the timeline for the ongoing project is 3 years. I gave an example for a project started in 21-22 that will last till 24-25. So that's the 3-year timelines given. CSR committees through specified entities. So here specified entities means trust, Section 8 companies and societies. I referred that they have to now file a CSR1 form to get them registered. CFO, this is another interesting. So far as an auditor, we have been asked to certify most of these balances. CFO will also be required to certify that with the board of directors, whether the fund which were disbursed is actually utilized for the intended CSR activity. So again, CFO also have to certify. But that doesn't mean that since CFO is certifying, we as an auditor in our report start writing that as certified by CFO, we also certify. That's not the intention. They will certify it to the board, and you will certify it back to the shareholder. So there is no linkage with their certification vis-a-vis our certification as an auditor. Those are two separate things. This is yes one of the compliance requirement at the end of the company that has to be discharged by the CFO. How to deal with surplus or excess, I'll be talking about it later. Again, for capital asset, I'll be covering that on the later part of my slide. Impact assessment. So,
Madam, the slides are not clear, madam. Varadaraj, the
is this
slides
not
are
clear?
not visible. No, not visible at all. Now it is visible.
Is it visible?
Visible, but
Is it visible, sir? Hello.
Visible, madam. Sir, visible, sir.
Was this dropped off some between, or is it not visible?
No, no. The slide is clearly visible.
Clearly visible.
Yeah, yes, madam. Yes, madam.
Yes, madam.
So should I move on?
Yeah, you can continue, madam.
Okay. Visible, right, sir? Again.
Yes, madam. Yes, yes.
Okay. Okay. So I was talking about impact assessment. Uh, any concerns, sir?
Sir,
Hello.
kindly unmute.
Venkatramani, sir, kindly mute, sir. Yes, madam.
Okay. Thank you. I was talking about the impact assessment study in certain cases. So another very good amendment that has come in CSR, I would say, that it's an impact assessment study in certain cases. Actually, it's an opportunity also if we take it as a chartered accountant. So what ministry has said, if a company is obligated to spend 10 crores or more, 10 crores they consider to be a material amount, significant amount, they are asking companies to get the impact assessment study done for those cases. So suppose there is a CSR policy where a company says that I'm going to spend my CSR spending, those say 15 crores towards poverty eradication program of my local community. In that situation, the ministry is saying, okay, you engage an impact assessment agency, a consultant, and that consultant can be a chartered accountant as well. You get that engaged, and that consultant will actually do an impact assessment study and assess whether the amount is intent whatever it was intended for the eradication of poverty and hunger in your society, whether it is actually utilized for the intended purpose. So they will actually monitor. So these kind of activities most of the time are undertaken through NGOs or trust or those. So these companies will these consultants will actually interact with those NGOs, look at their disbursement, their utilization program, look at their project implementation strategy. They will actually go on the site to understand nitty gritty of those projects and whether it has actually reached to the root cause. So that's the intent why this implementation study has been mandated for entities which have endeavored to spend more than 10 crores of rupees. So once this impact assessment study is done, that has to be disclosed next to the part of board report. So that is part of your CSR report that will come along with the board report, and it will be disclosed to the public at large. So it's very important in case your client is having more than 10 crores obligation in case of CSR, they get this impact statement assessment study also done. And this assessment study will actually support your compliance approach also, whether the policy is being followed, whether the company spent it actually, whether there are unspent amount. This will actually in turn support the our obligation to report finally as part of CARO also or as an audit report also. So that's why I said it's a good initiative both from the professional opportunity perspective also, and as an evidence also when we are discharging our obligation as an auditor. There are enhanced disclosure requirement also on board with regard to these impact assessments. They have to take it on record, part of their board minutes, and put the rationale also as part of their board report to in a summarized form on what assessment actually has reflected as part of board report. Moving on to the next slide. So I have just listed down some of the areas which were actually debated a lot, and answer to most of these have flown from the recent amendment. So there were queries on whether provision for unspent amount has to be done, how to deal with the cost when the amount is routed through a trust society or Section 8 company. How does a company deals with their expenses where their own employees are involved as part of undertaking those CSR activities? How to deal with capital items of CSR? Many such more requirements were getting debated, and all these got recently clarified by virtue of 2019 and 20 amendment. So I'll be taking all of them one by one on the subsequent slide. So if you can zoom this slide, so there is a flow chart which I have developed, and I've summarized how a company will start determining its CSR obligation from the beginning of the year and towards the end of the year, how that has to be reflected in the financial statement. So there would be a zoom option that will be available on your slide. You can see zoom it bit and see the text will be visible to you. So at the commencement of the year, the company will compute its 2% obligation or the net profit based on the 3 years or the lesser period from which the company has been in existence. After computing that amount, they know what is CSR needs to be spent. So I'll just take an example. So suppose based on this computation, I have ascertained that as a company, I am required to spend 100 rupees as a CSR obligation. As at the year end, I can have three scenarios. Scenario one, there is a shortfall in CSR spend. So I am supposed to spend 100 rupees. I spent only 70 rupees. 30 rupees is the shortfall. So ministry says, okay, check whether that is against an ongoing project or whether it is against an other than ongoing projects. Ongoing project I've already defined. There are two criteria: 3 years timeline or a project where a 1 year extension has been given by the board based on a justification. If that is against an ongoing project, any shortfall has to be transferred to a special bank account, which will be titled as unspent CSR account within 30 days from the end of financial year. So that is for an ongoing project. Suppose there is a not ongoing project. In that situation, the fund will be the shortfall of 30 rupees will be transferred to a fund. That will happen. That should ideally happen within 6 months from the end of financial year. So that is how ongoing versus ongoing project will be talked about. In first case, it will continue to be for the intended project only. And in case of other than ongoing, it will go to that fund, central fund like Prime Minister Care Fund, Swachh Ganga Fund, all those kind of fund, that amount should immediately be deposited. In ongoing project, there could another scenario that may appear after 3 years. So suppose after 3 years that amount is not spent, then ministry says that is also possible. You would not have spent, so suppose for 30 rupees you have only spent 25 rupees by end of 3 years, then that 5 rupees, that remaining 5 rupees has to be transferred to those funds, schedule 7 funds which we just talked about, within 30 days from the completion of the third financial year. So whatever way, the final amount should reach the ministry, should reach the government in whatever form, either through the contribution through ongoing project or societal activities, or you should immediately transfer to that fund which directly hits the central government account. In case of accounting, in terms of reporting, in both the scenarios for ongoing and ongoing project, the amount, the shortfall will be disclosed and recognized as a provision in the financial statements in accordance with the Ind AS 37 and AS 29. In case the CSI, now this was the first scenario where the shortfall has been taken care of, amount to be transferred, provision to be recognized. That's all. Second scenario, CSR spend is in excess of the amount. I was obligated to spend 100 rupees. I spent 120 rupees. 20 is my excess. How should I do with it? The amendment we just talked about 2020 came with the respite to the corporate. They said, okay, I will allow you to carry it forward. And that carry forward is again allowed for period of 3 years. So for everywhere, if you see, the period is 3 years, 3 years coined throughout CSR liability. So this is 3 years is very liked by ministry in this case. So compute the obligation on 3 years, for ongoing projects 3 years, for unspent, for excess amount also 3 years. They have been consistent on those 3 years criteria. So you board will pass a resolution in this case. Another condition that needs to be satisfied is this excess amount should not include any surplus arising out of CSR activity. By surplus arising out of CSR activity, an example could be the amount which you have actually 20 rupees. Suppose it was an excess. You have parked it in a bank account. You have kept it as an FD. The trust to which you have given that excess amount has parked it in an FD. And on that 20 rupees, it has got 2 rupees as an accrual for the interest. That amount has flown to the account. So 22 is the amount that will go back to the CSR obligation, because that 2 rupee will not be construed as your business profit. It has to be plowed back into the societal activities only. This was the second scenario. In this situation, your financial statement should recognize this excess amount as prepaid CSR expense, because that will be over a period of 3 years will be carried forward and set off against those obligations. Last scenario, there could be a surplus arising out of CSR expense. I gave an example of income accruing on the amount kept as an earmark for purpose of CSR. Ministry is very clear. Those surplus will not be construed as business profit, and it has to be plowed back in the same project or transferred to the unspent CSR account to whatever it is linked. So whatever fashion the CSR policy was talking about that amount to be spent, any surplus arising related to that amount CSR obligation would need to be linked back or plowed back to the respective identified project only. In that situation, that surplus will be recognized as liability, because there is no estimation which is involved on how much amount that will get spent. The amount, the surplus is very clear. It is known to you on day one. So it becomes a liability, sure shot liability for you, and it has to be recognized accordingly in the financial statements. Moving on to the next part. So there was specifically for listed entities, there was concern on, since the ministry mandated that unspent amount has to be recognized, provision has to be recognized for CSR unspent amount. Then there were concern about the listed entities or companies which are following an interim reporting also, whether this provision has to be accrued on interim period basis. So for example, quarterly basis, where the listed company is preparing a quarterly financial results. So if you see the intent is very clear. In the beginning of the year, you compute the CSI spend liability, and towards the year end, you assess the shortfall, excess, or surplus, whatever is arising. So the amount have to be spent in the financial year. Company will not be able to assess what amount I'm going to spend in a quarter, what amount I will spend in 2 quarters, or so forth. The obligation spent during the year. So you will get to know only towards the year. So there is no mandate to recognize provision for CSR as at the quarter end. So it has to be assessed only as at the year end. Unless there is another kind of obligation because of a contractual agreement which the company has entered to discharge their obligation, no such provision will be recognized. And it has to be as a best practice. Company can decide to disclose it as on voluntary basis in their financial results. Beyond that, it is not mandated. So even if disclosure is not done, no, it's not a non-compliance. It's just a voluntary requirement as a good governance. So no provision, no disclosure mandatory required. Disclosure is voluntary only, and provision is not at all even voluntary. You should not recognize it because there is no obligation as such on quarter basis. So that's pretty clear. There is no ambiguity on this. Next part is how to deal with salary of own staff or administrative overhead. For this, there could be two scenarios. Suppose your client is undertaking a CSR activity. They want to go to school to discharge their CSR obligation for the educational program. And as part of those activity, they could have two employees, two categories of employees. One employee is hired specifically to monitor the CSR obligation for the company. So that employee is housed in a department which undertake the CSR initiative. That employee entire salary cost will be allowed as a CSR expense. There could be another employee who, because of its inherent nature, wants to support the drive of the company. So okay, the employee says ki, okay, my company wants to support educational program, I also want to contribute some hours to that. That employee also goes along with the CSR team and spends some hours on the CSR activity. For that employee, the hours spent would be construed as a part of administrative overhead. What is administrative overhead? That is also defined. It is something that is expense incurred by the company for general management and administrative purposes for CSR obligation. So the employee cost will be not taken in full. It will be capped within 5%. So there is a cap of 5% of total expense limit. So if there is suppose 100 rupees, which is your CSR obligation, 5% of that 5 rupees is something that could be attributed towards administrative overhead cost. So out of 100 rupees, 95 has to be other clear cut expenses on CSR activity. 5 can be towards administrative overhead that can be loaded on as a part of CSR expense. So the employee who is not a part of CSR group, not employed for undertaking CSR activity, that employee's cost will be clubbed in that overhead cost of 5%, and any amount over and above will not be treated as a CSR expense. Payment to consultant. Payment to consultant will be similar to that employee's cost only and will be capped within 5% of total expense. It will won't be allowed in full. It is a consulting fee that a company is likely to incur. It is nothing to do with CSR expense. So it will be treated as administrative overhead only, and it will be capped within that 5% of overall limit. So on this slide, we are going to talk about those expenses which get routed through trust, society, or similar institutions. So since the law allows company to undertake these initiative through these kind of organization structured society, trust and Section 8 company with a track record and which are registered, there could be two scenarios again for this. One, company has given that amount to that trust. So I'm taking an example where a company ties up with a trust, and it says ki, okay, I will give you the amount which I'm obligated to spend for my CSR policy, and since you are engaged in that kind of activity, you take that amount and make sure that on my behalf you are spending it. And as per the contractual agreement with that trust, the amount is not recoverable. It is totally left to the trust to make sure that the amount is spent. In that situation, the entire amount should ideally get treated as a CSR expense. But there is a catch to it. Recently, ministry came up with an FAQ. They said directors, they have casted a duty on, I would say, an obligation on director that you make sure whatever amount is actually getting spent by trust is something which is getting disbursed by the company. That is technically not possible. A board cannot sit in the beginning of the year and decide, okay, the trust will be only able to spend this much portion of my amount. There could be XYZ reason. COVID-19 was one of those reasons. Nobody had a control over it. So board cannot make that assessment upfront. So although boards should be diligent in ensuring that they are monitoring the implementation of these activities through trust, but they cannot preempt whether that amount will actually be spent by trust or not. So that FAQ is little can lead to an interpretation issue, but so far we have not seen any major concern around it for companies who are actually treating that entire amount to be spent. So if the board has no control, in my view, it should be allowed as a CSR spend. Although if we take a literal reading of that FAQ, they may lead to a different interpretation that no, only the amount which is spent by trust should be treated as CS expense. But my pure logic why it should be treated in whole is I have no control as a company on that amount. It is not recoverable. It's gone. I gave it for the intended purpose. I was monitoring it through and through. I have documents to prove it. I should be allowed to be treated as fully as a CSR expense. Why I wanted to highlight this because you should be cautious enough in assessing, telling the board that they should clearly keep monitoring these items to be able to justify if some kind of query comes from regulators in this regard. So this was one scenario where the amount was not recoverable. There could be another scenario where the amount which you have given to trust, you have clearly mandated that trust. If you have not spent that amount, you have to by say suppose by 25th of March. If I have a financial year of January, April to March, by 25th of March, if you are not able to spend that amount, return that amount back to me. In that situation, the amount which is spent by trust will only be construed as your CSR expense. The amount which you are going to get back, it will be treated as an unspent amount, and you should see whether it is towards an ongoing project or non-ongoing project. Since you have taken that amount back from trust, obviously the project is not there; it's over. It would be better that amount gets transferred to fund within the stipulated time frame to be able to justify to the regulator that you have discharged your obligation in accordance with the law. Moving on to the CSR expenditure on capital asset. So prior to this amendment, how it was being done is a company has a suppose I'll take an example of a company where it has developed a huge hospital premises within a township. They have developed a hospital premises also. So the hospital has two blocks. Bigger block, they are actually running it as a proper commercial hospital, discharging earning out of it. It's one of the streams which the company is getting revenue from. And there's a significant portion, another block of hospital which is catering to the weaker section of society. The asset, both the blocks are being capitalized as part of that company's fixed asset, property, plant and equipment. So companies were taking depreciation on those asset or overhead related to those asset, which was a block, which was actually dedicated towards the weaker section of society, and were claiming it as a CSR spend. Ministry realized ki, okay, you are telling me that asset is attributed towards the CSR expense. Then why you are controlling that asset? Why it is there sitting in your balance sheet? Why don't you take it off? You just transfer that asset. So they came up with the amendment. They said ki if a company has spent the CSR spend has been made for creation or acquisition of a capital asset, you should not control it. You should immediately transfer that. So they gave a timeline of 180 days. So since the notification got effective in 21, the 180 days is already over now. So the companies were mandated to transfer that capital asset to a company established under Section 8 or registered public trust or society, which is undertaking that CSR objective, discharging their obligation towards the society, or which to the beneficiary of trust. So suppose there is a Gram Panchayat self-help group, women empowerment group, child support group, those kind of group. If those are kind of self groups are also there, those can also own these kind of asset and run it as part of their own initiative. Similarly, there is a public authority. The definition is available in the law, which are notified as public authority by the government. Those can also own this capital asset to discharge the CSR activities in the intended manner. So now the companies cannot no longer be able to control this asset or capitalize this asset in their financial statement. It has to go and sit with the respective authority or society or self-help group forever for whatever reason it was built up for. It can no longer be under the control of the company. So these were some of the legal requirements which we have to be careful in while making an assessment, while recognizing the asset or recognizing expense in our financial statement, and we as an auditor for assessing the compliance with that. Now I'll move on to the board's part. If how the board has to look into these amended rules. So board has to be being sitting in the fiduciary capacity is very much obligated to ensure that the plan of CSR is running in the intended manner, and they are authorized within the amended rules now that to alter this plan. So based on the CSR committee recommendation, board is authorized to make requisite alteration to the CSR policy based on the reasonable justification. So whenever you see an amendment to CSR policy, make sure that board's resolution takes into the record the reason for making that effect, and it is supported by a recommendation from CSR committee. Then CSR implementation, we have already talked about that it can only be undertaken if the company is not taking on its own. It can only be taken through other entities which are registered with ROC in form CSR1. CFO certification, we have already spoken about it. In case of ongoing project, board has to clearly monitor its timeline, year-wise allocation or modification in the intended timeline. All this should be clearly recorded because this is something that will form part of your CSR impact assessment. Even if it is not done by an outside consultant, still as part of as a CFO of a company, you will be required to give a certification. So you should clearly monitor all these kind of allocation approvals which are being accorded to a project if it is not completing in the permissible timeline. So we have talked about capital asset and excess set off also, how the board has to take it clearly on their record and pass requisite resolution in this regard. With regard to disclosure, there is a specified format specified by the regulator in Annexure 1 and Annexure 2. Annexure 1 is applicable for financial year beginning on or before 1st April 2020. And in case of companies which are reporting after April 1st, 2020, Annexure 2 will be the relevant format. Impact assessment, we have already talked about how a consultant needs to be hired when the obligation is more than 10 crores, and that will be placed for the board to take it on record, and it will be annexed to the annual report on CSR. CSR disclosure, historically also and currently also, will continue to be form part of website of the company so that it is easily accessible to the public at large. So this is the disclosure format. I have tried to capture the key disclosure requirement. It's not the complete list. Again, for it's a illustrative thing. For the complete list, please look into the Annexure 1 and Annexure 2, depending upon the year to which accounts are being prepared. What is more relevant, because we are sitting in 21-22, is on the right hand side, Annexure 2, where the composition of CSR committee, your CSR policy outline, impact assessment, details of set off, average net profit, how it has been arrived of, whether there is a surplus, any set offs to be done, all those details which we just has been talking about in preceding slides needs to be given as part of Annexure 2. Penal provision. So I gave a background on how it started with comply and explain approach, which is no longer acceptable to regulators because of vague reasons given in the board report. The intention of the law was not met, so they made it more stringent. So if the company is not being able to spend the amount or spend the amount for the ongoing project or transfer that amount within the stipulated time frame to a fund, then in that situation, the company will be penalized, and the penalty will be twice the amount which is not spent for the intended purpose, or rupees 1 crore, whichever is less. And every officer in default. And we all know whenever a default happens, the directors are by default officer in default. So they will be obligated to by penalty of 1/10 of the amount which is less, that to be transferred, or rupees 2 lakh, whichever is less. So there are penal provision, but my request to all of you is do not apply materiality to this provision, because this compliance with this section is closely monitored, as I've been talking about by CSR cell, and the intent is very clear that amount should go back to the society. So be very careful, please do not apply any materiality to this kind of provision. And if you are reporting in the capacity as an auditor, make sure that you report whatever is the situation with the company. If there is an unspent amount, report that unspent amount. If the amount is deposited with a delay, report that delay. If the amount is not spent at all, report that. Don't be hesitant of okay, client will do it one day in with a delay, 2 days a delay. Just be factual, be transparent, and just report it. Um, so another thing is like a question that keeps coming it, what if my client has not constituted a CSR committee? 135 is not talking about that. In that situation, the provisions of section 450 of the Companies Act, that's the general prenup provision that will trigger, and the company would be required to constitute a CSR committee before they proceed for compounding of this offense. So those provision will be triggered. So your client should not make an excuse, okay, I will not make a CSR committee because 135 is silent on this. No, if a particular section in the law does not deal with the provision, penal provision, for non-compliance of the provision, we have to go to the General Clauses Act. So 450 will come handy in that situation. Moving on to the disclosure requirement for preparers. So if we are the preparers of the financial statement, we have to carefully evaluate whether the requirement of guidance note on accounting for expenditure on CSR are met. So there, as per the guidance note, gross amount spent, or whether it is spent on construction, acquisition of asset, paid in cash or otherwise, all that needs to be disclosed. Recently, guidance note of schedule 3 also got amended. In that situation, if the trust which is undertaking an activity, you should disclose whether it's a related party as per India's or accounting standard. If it is if there are unspent amount, those have to be disclosed. So more or less the schedule 3 disclosure is in line with your annexure 2, where you have to submit certain information in a pre-populated format to the registrar of company. Schedule 3 to a great extent complies with those disclosure requirement, so that financial statement also speaks in the same language. Auditor responsibility, I've been emphasizing specifically on this, that caro 2020 is very clear. There is a clear clause, there is a clear reporting requirement on CSR. Be very factual in whatever you're reporting for your client. If there are serious non-compliances recorded, you may want to consider modifying your main report also, although there is a caro clause 2020. But if you notice that the compliances are serious in nature, what is serious is, I'm leaving it to your judgment, because you are the best judge of your client situation. So if you see that amount it is significant, you consider modifying as per SA standards on auditing 705. Otherwise, reporting in caro should ideally suffice if the delays are minuscule, like 1 day, 2 delay, all those kind of things. Other reporting obligation for you as an auditor will flow from standards on auditing of 720. This is a standard which deals with other information. So whenever a financial statement goes out, we typically say that annual report goes out, annual report goes out. Financial statement is one thing, financial statement is part of that annual report. It is, annual report has massive information other than what is there in the financial statement. It has directors report, it has corporate governance report, it has your MD&A report, all those kind of report is there. So what SA 720 says, if your financial statement is going along with other information, you better assess that information also. So it's always good for you, and that's the ideal situation, that whenever you're signing your audit report, you should have the board report also handy with you, because only in that situation you'll be able to tie up whatever is reported in the financial statement, whatever is reported in the board report is actually consistent. Unless you have that handy, you'll not be able to make a comment on that. Although 720 envisages a situation that you do not have some information upfront at the time of getting an audit report, but it's always a good practice that you insist on obtaining a draft or director report when you are signing those financial statements, so that you comply with SS 720 to a fullest extent, and later on you are not surprised with any inconsistent information which are noted, for which you are writing letter to your client saying that you reported this in financial statement, however in your board report you landed up saying this something this. So all this can be better avoided if everything is given to you as an auditor at the time of signing audit report. So that's how that's where SA 720 comes handy. So this is what I had for you as an auditor. Since I had already talked about this being a great opportunity for us as a profession, we can get tagged with the NGOs, trust which are undertaking these kind of activities to support, to certify the utilization of funds for the intended purpose, look at the policy and do an impact assessment. We can be part of board, we can be auditors, we can be preparers. So all sort of these opportunities are available to us as a profession. So with this, I close my session, and we have good 30 minutes. If you have any questions, I'm happy to take that up. Thank you.